Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Liz Young. How you doing today, Liz?
Hello.
Yeah, thanks for joining us. Happy to have you on the show here. For the listeners who don't know you, maybe you can tell us a bit about yourself and your background.
Sure. So I run investment strategy at SoFi. For those of you not familiar with SoFi, it is a financial technology company, financial services. We offer products across the spectrum, across an investor's and a banker's lifespan to help everybody at different stages of their life. And it's an app-based platform. It's a very progressive company and one that I'm really excited to work for. I've been here about 3 years. What investment strategy means along that vein is that I produce all of the content related to investments for the company across multiple platforms. So I take basically what's happening in the macro environment, distill it down to what that means for capital markets, and talk about how that can affect your portfolio in particular. I do podcasts, I do broadcast, I do radio, I do everything. I write. We've got social media content that goes out on a daily basis, just keeping people in tune with what's happening with the data releases, what's happening with market moves, and our thoughts and thought leadership on what we see coming ahead.
Wow, that's a lot. Do you have any time to eat?
Occasionally I eat. Yes.
Nice. Well, good for you. So this is great. So tell us, how did you really get started in this field? Like this is I've known about SoFi for a while, but
Mhm.
curious how you kind of got to this place and how you got in this field to begin with.
Yeah, so I say this all the time. SoFi is the fourth company I've worked for in my career, and it's the first one that's less than 100 years old. I started in pretty traditional financial companies. This is my 20th year in the finance industry. I can't believe it makes me feel so old to say that, but my 20th year, and I began at a regional bank back in Milwaukee, Wisconsin. I'm a Wisconsin girl, and I worked there in the operations department for about 4 years before moving on to other areas and moving up in the organization and learning more about basically the industry itself. And, I truly believe that everybody has a few really important inflection points in their career. And if you're lucky enough to have more than one, then grasp onto it. And it's one of those things that as an opportunity comes your way or as something comes up that maybe you weren't expecting, it is up to the individual to be open to it and to be willing to say yes, even if it doesn't seem like something that was in your plan. So back then when I started, I thought I wanted to be in corporate finance. I thought I wanted to be a CFO, which now that I think back to that, I'm not sure where I got that idea from, but that's what I thought I wanted to do. I liked math. The numbers seemed easy enough for me, and it was easy to understand. It was concrete. And I was sort of on that path, or at least I was going to start going after jobs that were going to get me to that place. And you go through periods where I applied for, I think, three different jobs at one point in my mid 20s, didn't get any of them. One of them was in corporate finance, one of them was investment banking, another one was at a hedge fund. And again, didn't get any of them. And I think it was a message of, okay, back to the drawing board or just stay where you are until you figure out what the correct next step is. And somebody came to me and said, I know you're looking. We've got this opportunity to work for the chief market strategist. And it was at the same company I was working at to work for the chief market strategist. He needs an analyst. He's interviewed a ton of people. We don't really even know what he's looking for anymore. So why don't we give it a shot? So I went, really against maybe my will. I wasn't sure that it was something I was even interested in. And fast forward a little bit, he hired me. I was by far the greenest person that he had probably interviewed. And he hired me, he gave me a shot. And that's where the dream began. That's where, I looked at his job. I worked for him for 2 years. I looked at his job and said to myself, someday I want somebody to give me a job like that. And I assumed that it would take decades for somebody to give me a job like that. But at least I had the goal. I had that pipe dream and I had an idea of what I wanted it to be. So that's sort of where it all began. And then I would say I was off to the races, but that's not even true. You end up kind of meandering through a career and trying to figure out what to do. And I eventually ended up in New York City, which is a story. If you want the entirety of, I'm happy to share, but a lot of different stops along the way and a lot of different corners that were turned to get me to this place now where I'm in a seat that, yes, I'm busy and yes, it seems It seems frantic when I talk about what I do on a daily basis, but I love it so much. And it is truly one of those jobs for me where I have found a place in finance where I get to communicate, I get to connect with people, I get to help people learn, I get to help people feel empowered about their investing. And it is so much fun.
Yeah, it's interesting. I mean, finance is I've talked to a lot of people who've kind of gone down that path, and it's not the easiest path to understand, right?
Mhm.
There's so many different, in some professions you could say, "Oh, it's easy. I just do A, B, C, and D and I'll get to my goal." In finance, there's so many different paths that you can go down. Like, what would you recommend to people that are considering getting into finance because there's so many areas and it's hard to navigate?
Yeah, it is hard to navigate and it's really overwhelming. I also think people have a predisposition for what they think the industry is and what they think all of the opportunities are until they get into it and really understand how broad it can be. So, what I would recommend if you're early in your career and thinking about a job in finance, you do have to try quite a few different things. You have to try your hand at it. And one of the fallacies I think of being a young professional is that you know you're young and you know that you're new and you know that you need to learn. So a lot of times what happens, and I mentor a number of young professionals and I see them fall victim to this every time they start in their first couple jobs in the industry and they get to know that particular subject matter. And then that's where they're comfortable. And that's where they want to stay because that's where they're comfortable. And those are the interviews that they'll get in that same subject matter because that's what their resume says and that's what their experience says. But those early days, I would even say that first decade of your career, you have to force yourself to do stuff that is outside of that zone, purposely try different things even if you don't think you're going to be good at it. And you may not be, but that's okay. At least you know the answer. So you do have to try a number of different things before you can really know what interests you. So the other thing I think young people and when you're trying to figure out what you want to do in your career, one of the things that I think we think about backwards is, well, let me just find the subject matter or the material that I find interesting and that's what I should do. And that's part of it. But that same guy who hired me when he was the chief strategist, he said something to me once and I will never forget it. He said, "Happiness at work is only 20% about the subject matter. The 80%, the other 80% is about the people you work with." And I would even expand that further to say 80% of it is maybe the people you work with and making sure that you're in a seat where you can do what you are good at. And it's not necessarily about subject matter. It has to be about what your personal skills are and what's different about you versus your peer group. And that's something that you have to try to determine in that first decade of your career.
Oh, that's great. I hadn't thought of it that way. That's a very small percentage is the subject matter. And I guess dealing in finance and the markets, some days maybe it's higher, some days maybe it's a lot lower.
That's right. Yep. Yep.
Yeah, I mean that's actually one of the biggest challenges that in certainly I've had and every advisor I know has had is that we're subject to the market conditions that we have no control over, and yet that dictates a huge part of our own happiness, and it's the
Hmm.
one thing we can't control. We can control the
Hmm.
people, we can control the process, we can control a lot of things, but we can't control the outcome of the market, and yet markets going up 20% or down 20% is a huge impact on everyone's happiness. So,
Yeah, well, and in a role like mine as well, it's I'm paid as an opinion, right? I'm a hired opinion. I'm here to tell people what I think the market is reacting to. I'm here to tell people what I think the market might do in the future. And it's really difficult because I'm wrong a lot, and most of us are, because you can't predict the future. All I can do is take the information that I have, the experience that I have, and say, here's the best guess that I have. Here's the thesis that I have about how things might shake out. And these last couple of years in particular, I mean, it's been people have been wrong for extended periods of time, self included. So if you are going to choose in a part of the industry where it's not that clear cut, where your opinion is a lot of it, you have to get comfortable with and get used to the feeling of being wrong. And the idea that no matter how long you're in it, like I said, if this is my 20th year, I still feel like a baby in it many days. no matter how long you're in it, no matter how much experience you have, no matter how hard you work at it, you're still going to be wrong sometimes. And you have to be okay with that and embrace it as a lesson, embrace it as an indication of, do I need to sharpen my pencil and try this again? Or embrace it as, I still think I am being intellectually honest with myself about this. And even though I'm wrong right now, that doesn't mean I'm going to be wrong forever. And I'm going to stay true to what I know about this, stay true to the information, and stick to my guns. And some of that, it takes a lot of stamina. It takes a lot of resilience and a thick skin, frankly.
So what kind of mental models would you suggest that people consider if they're looking, because the market will humble all of us. Like nobody's right
Yep.
all the time. And if you're lucky, you're right 50% of the time. Most people aren't even right that much. Um, but what mental models do you think could help people uh, become more at ease with the market's volatility and direction? Um, because I've learned a bunch over the years, but I'm curious in which ones you think might help investors.
Well, I think of things a lot using the business cycle. And I think the tricky part about that is that business cycles, although they all include the same phases, you've got an early part of the cycle, mid part of the cycle, late, and then usually a recession or contraction that starts it all over again. And then you begin early, anew. And the difficult part about a business cycle that I think investors struggle with the most is that we don't know how long they last. So you end up thinking that we're going to transition into a new phase of the cycle, or thinking that we're going to transition into a recession or out of a recession. Things take much longer than you expect them to. And that's something that you build up sort of over time, but frankly, every investor, no matter how old and no matter how long they've been doing it, still gets impatient every time with the business cycle. And one of the things that I think is really important to remember is that if you, and everybody knows this, if you look at a really long-term chart of the S&P 500, it moves from the lower left to the upper right over time. If you take smaller portions of that, so if you take, let's say, 10-year periods from 1926 until today, you might find a few 10-year periods that are flat. And that's unfortunate. That doesn't happen very often, but you might find a few 10-year periods that are flat. If you extend that out to, let's say, 12 to 14 years, you won't find one that is not sloping upward. So if you think about your own investment horizon, your own time frame of, if I've got at least 10 years, it looks like, according to history, the worst I'm going to do is flat. If I've got more than 10 years, I will make money, right? The idea that that is the length of time, and it's not that you can be guaranteed that, of course, unless you're invested directly in the S&P 500 and you're following the market, which nobody really does, nor should anybody really do. But if you can think about it over that longer time frame and know that, yes, there are going to be periods where you made maybe a bad decision, a bad buying decision, a bad selling decision. But if you can stick to the core, stick to your strategic allocation, and frankly wait out a few business cycles, you usually end up better for it.
Yeah. No, that's really helpful. So let me ask you this. I mean, you mentioned the business cycle, and one thing that's happened, at least in my observation, and I've been doing this for 25 years, so I have some personal anecdotal, stuff. And
Mhm.
in my observation in the past, the market has generally been pretty good at predicting business cycles, especially the bond market. The bond market's always been very spot on. But I feel like since they started raising rates
Mm.
a few years ago, the bond market has been way off. The market has been predicting even even before they started raising rates. They just said, "Hey, we're going to start raising rates in January." And a few months before, they're like, "Oh, they'll drop it 3 months later." Like it's always been built in that 3 months later, 3 months later, they're going to start dropping rates. They've been wrong for years, and so I'm wondering, A, what's changed?
Mm.
And B, how should investors view this very dramatic change in how the market is perceiving the future when normally it was a little bit more on par with where things typically go?
So what's changed is, number one, we've got a lot more individual investors with a lot more information. taking part in the market. And I think that is a wonderful thing. I think that is absolutely incredible. And I think, especially since the global financial crisis, and so many people felt like they didn't understand what was really going on, or they felt like the wool had been pulled over their eyes. The fact that we have so much more transparency today and investors are so much more involved in their own financial journey, I think is great. What it did, though, to the market is it made us even more impatient. We've got more information at our fingertips. We've got it coming in constantly all day long. And it gives you the impression that you're supposed to do something with it every single time you hear something new. And you are not supposed to do something with it every single time. The Fed also talks a lot more today than they did 15 years ago. They have more press conferences. They have more speakers between meetings. We have all of that, again, all of that information that we think we're supposed to react to. And we do react to it, which creates volatility, because as soon as the message changes, or as soon as what we thought was priced into the market, the sentence that comes out of a speaker's mouth 2 days later, then we have to reprice it. So there's a lot of this sort of trying to catch up with our own interpretation of what's being said. The market itself, so I want to make a distinction here. There's the bond market for sure, right? We've got things like an inverted yield curve, which still tell me that we're late in the cycle. We've got really, really tight credit spreads, which tell me that we're not necessarily overheating, but that risk appetite is still pretty strong. People are not all that concerned about debt. But then you've got the Fed funds futures market, which is the thing that tells equities and bonds basically what investors think the Fed is going to do. What are they going to do at the next meeting? What are they going to do 3 meetings down the road? That has been, in my opinion, uncharacteristically volatile. That has changed quite a bit and quite quickly. When we started this year, we had the Fed funds futures market pricing in the first rate cut in March, and it was pretty certain. It was, I think maybe it got up to 80 or 90%. Pretty certain that we were going to get that first cut in March, and it was pretty certain that we were going to get 6 total cuts this year. In less than 2 months, that changed to we've got the first cut maybe in May, more likely June or July, and only 3 for the year. So things went completely the other direction very quickly, only because Powell said a couple things, right? And only because we had speakers that said a couple things. The interesting part of that is we had hotter inflation data than everybody thought would come in, which, yes, should push cuts out, but also probably should have caused a little bit more volatility in equities, and it didn't. So the reaction function of the market, I think, has changed because it's more impatient, because it's more short term, and because we are conditioned, especially in this cycle, we are conditioned to be saved. We are conditioned that if anything should go wrong, if volatility should get uncomfortable, that there will be some sort of backstop, some sort of softening element that quiets things down again. That may end up being the case. That hasn't been proven wrong yet. But if that starts to happen and the Fed doesn't come in to save it, which who knows what's going to happen now. The good news is they have a little more what you would call ammo, right? They have rates at a certain level where they can cut to protect it. They can, the Fed put, the so-called Fed put is back. But if they start to use that ammo in response to weakening data or in response to uncharacteristically high volatility, I don't think it's going to be met with a positive response in markets.
Yeah, see, this has been one of my biggest questions. I try to, I mean, the markets are highly complex, so I try to think of things like what is the simplest way and simplest framework to think about the markets, and and what that has been for the longest time has been basically where the market's going when we have low interest rates. You just assume like, all right, they're going to lower rates or they're going to keep them low. Like it's just basically, like you said, the Fed put. But now that we have higher inflation, that's changed the game. So now it always was pretty simple. Hey, the market goes down, they're just going to lower rates and they're going to print money. That's what they've done for years. They're going to continue doing it, and people are conditioned that way.
Right.
The question I have is now that we have higher rates, real question is, what if inflation stays up and the markets go down? What do? Do they lower rates to save the market? And which could basically pump up inflation quite a bit? Or do they, like which path do they do, right? Do they lower rates? Do they keep them the same? So which are they favoring? They favoring, I want to protect against inflation or I want to protect the market? And I don't know if I have an answer. I'm curious on your opinion on this, but this is how I viewed it. It's like, which way are they going to go? Because based on that decision, all of my future decisions are going to be based on that. And I don't know if we have an answer yet. So I don't
Right.
know. What are your thoughts?
So I have a lot of thoughts on this. And again, these are just my opinion. This
Of
I don't
course.
talk to Jerome Powell. I have no, no
Why not?
idea
Come
what
on.
well, he won't answer my calls. I've tried. So here's the tricky part of this year in particular. It's an election year. We all know that. I would like to believe that he will not be swayed, that the Fed, the FOMC, nor Jerome Powell will be swayed by the election. Jerome Powell is not up for renomination until 2026. So there's not like a looming nomination that he's hoping for early next year that he may or may not get, depending on who's in the White House. That he's still got 2 years. Also, who knows if he even wants the job again? I mean, this has been a difficult one, and perhaps he doesn't even want to be renominated. We obviously don't know the answer to that. So what the Fed is tasked with, what their mandate is, it's two-pronged. It's inflation and employment. They need to maintain stable prices and maximum employment. So regardless of what the market does, that should be their mandate. However, they added in the last 5 years or so, uh, basically what's called a financial stability report. And they have been more clear publicly about the fact that they do monitor financial stability. So if the market should start acting in a certain way, and I would even go further to say if the bond market starts to act in a certain way that is no longer stable and that is not sustainable, that's when they feel more apt to step in because of market movement. And if you remember what happened during the pandemic, we had high yield bonds in a world of hurt. We had credit spreads that blew out very quickly. The bond market stopped functioning as it should. And given how big our bond market is and how influential our bond market is around the globe, they stepped in, they bought some ETFs to stabilize the bond market. This was also around the time when oil started trading at negative $40 a barrel. Obviously, things were not functioning as they should. That was a huge shock to the system. So they stepped in, and we can debate all day long whether or not they should have. According to their financial stability metrics, they needed to. So I'm not going to argue with them on that. I think in this part of the cycle right now, the fact that we have been looking at inflation as public enemy number one, I think they are still looking at it that way. I think they are watching the labor market very closely to make sure that there aren't little spots of weakness showing up that they're uncomfortable with. But I think the Fed's threshold for pain is going to be much higher than the market's threshold for pain. So even if the market does wobble, keep in mind we've had a pretty ferocious rally since October. Even if it wobbles a little bit, I don't think the Fed is going to balk at that. I don't think they're going to be upset by that, especially if they haven't yet been convinced that inflation is on a sustainable path toward 2%, which is what they continue to say at every meeting. They need it to be on a sustainable path. They need to be confident that it's on a sustainable path toward 2%, and they're not confident yet. We've made a lot of progress, but they're not confident yet. And the other thing that I continue to reiterate that Jerome Powell has said multiple times, I don't think at every meeting, but quite a few of them, that high inflation doesn't work for anybody. High inflation does not work for any part of the economy. So I do think that that's still going to be their primary concern. And I think that they're willing to withstand some market turmoil in order to accomplish that task.
Yeah, it's interesting. If I think about, what was it last year, 2 years ago? I forget when it was, but at one point in the last, I guess, 12 months or so, most people would have predicted that we hit a recession. And of
Mhm.
course, our president decided, no, it wasn't a recession, and everyone just kind of accepted that. and and their argument was, like, let's recreate the rules. But at the same point, I didn't totally disagree with their sentiment. Like, I disagreed with the fact they're trying to change the rules to make themselves look good, but I think the rationale was like, all right, I can see your argument, right? Like, I can see both sides of it. But it kind of makes me wonder, like you mentioned the business cycle, like where are we in the business cycle and why are we not hitting a recession when
Mm.
every Tom, Dick, and Harry and Susie are out there saying, well, it's going to be a recession in 3 months, just like the bond market's going to lower rates. And it makes me wonder, like, where are we in the business cycle, and why have we not rolled over when we've had an inverted yield curve for what, 2 years now?
Mm-hmm.
So I don't
That
know
is
your
that
thoughts.
is literally the $1 million question. And the debate right now, I think, has become, are we in late cycle euphoria, or are we in early to mid cycle expansion? And the analogy I've been using for the last week or so is, it's almost as if you're trying to figure out whether you have the flu or if you have COVID. The symptoms present very similarly at first. You feel the same. You've got a fever, you've got a sore throat, you've got a runny nose, you're fatigued, you've got body aches. It's the same. Probably for the first few days, it's the same. And you still don't really know which one it was unless you take a test. Unfortunately, there's no test for the, for the business. Like, I wish there was. I wish we could just give it a little test and say, where are we, early, mid, or late? That would be so much easier, but we can't do that. So you don't find out perhaps until, I don't know, a week later, 2 weeks later. And it's more about, did I lose taste and smell? And if you lost taste and smell, chances are you had COVID and it wasn't the flu. But that's after the fact. So we don't know right now. And frankly, there's data to support either case. And the market is acting as if it could be either case. Now, if you look at what's happening, the broadening out that everybody keeps talking about in the market, we've tried to broaden out a number of times, and it has been true. We did broaden out. And what I mean by that is things like smaller cap companies are taking part in the rally. Other sectors besides technology are taking part in the rally. That's a broadening out that ends up being healthy. It looks healthy because you want there to be strength coming from more than just 5 to 7 names in the broad index. So that usually is a good thing. And now accompany that with the fact that inflation has come down, the labor market has not cracked. That's where people have started this idea of, you know what, we're early to mid cycle and we've got a lot of room to run. I still look at it as the risk taking that's occurred, particularly in concentrated parts of the market, the risk taking that's occurred and the multiple expansion that's occurred. What I mean by multiple expansion is that certain stock prices seem to have gone up, not necessarily based on fundamentals that got that much better, but just the expansion of the stock price itself, because momentum is at play, enthusiasm is at play. Maybe the stock was a part of a theme, like the AI theme, or maybe it was the weight loss theme. That multiple expansion, if it's not based on an equal amount of fundamental improvement, that starts to tell me that we're more late cycle euphoric, and it begins to start to breed on itself in the sense of people want to jump in and not miss it, and the FOMO trade. And then you start to have lower quality things that rally with that. The last thing I would say is, when I think about what the macro environment should be telling us if we are early to mid cycle, generally speaking, the labor market is the last thing to go in both regards. It's the last thing to crack in a recession. It's the last thing to recover once we've come out of a recession. It recovers very slowly, but it does feel its pain pretty quickly, but it's usually the last piece. The labor market has not cracked. We've got still historically low unemployment. We thought it was going up for a little while, and then it went right back down. Now, the state level unemployment rates are telling a different story, but if we just look at the national numbers and jobs added and still the jobs that are open, it's still a very healthy, if not tight, labor market. If we were early to mid cycle, my take is that the labor market would be still a little unhealthy and recovering, meaning the unemployment rate would be higher and falling. Jobs added would be increasing. Job openings might be a little uncomfortable, but increasing. We're doing it the opposite direction. And that's, again, what tells me that we're late cycle. Inflation, yes, absolutely has come down. 9.1 was the peak. We're back down in the low threes. I think that's great. We're even getting to the high twos, depending on how you want to measure it. And that is great. But prices have not come down. They just stopped going up as fast. So we've got this cumulative effect of inflation that's happened since inflation started that is pinching people. And that's something, again, that is a symptom of an overheated economy that we're trying to cool off. So far, we've been able to absorb the inflation that is here, But I think that we are running out of ways to absorb that, especially at different income levels in the consumer spectrum.
And how does that kind of sort out? Because if I think that that last point you made is really important, right? We had this cumulative inflation. Everyone's getting squeezed. I mean,
Hmm.
I've talked to
Hmm.
tons of people, and everyone's feeling it up and down this. I mean, obviously they're really wealthy or not as much, but
Hmm.
for most people that you've got a budget, and now your budget. I mean, I look at what people said. I forget the most recent inflation numbers. It was like 5% or for food. Like,
Mm.
I don't know what they're looking at, but my food has gone up like over 100% in like the last 2 years. So maybe they're looking at one piece of food that I'm not eating, but it's not it's
Yeah,
not in what's
they're
in my
they're eating
basket.
hot dogs and that's it. Yeah. Well, so a couple things. And while I'm saying this, I'm going to try to pull something up so that I can give you some better data. But so if you look at certain types of inflation, obviously we had this big goods inflation issue that happened right after the pandemic, in the sense of, you've got used car prices that went up so much, and we had food prices. There was beef and the wheat and everything else. We had all these different whack-a-mole issues. It seemed like every few months we came up with a new thing that was causing the problem. But eventually it all sort of calmed down and people got a little bit less upset, right? Energy prices came down. The issue is that now we've got goods prices that have come down, or goods inflation. I shouldn't say prices, goods inflation that has come down. So that doesn't seem to be the issue anymore. Now it's the services side. So then we created these new measures of inflation, the super core, which is core services X housing. I mean, what's even left in that bucket? Food isn't in there. Housing isn't in there. Energy isn't in there. It's like, what people do on a daily basis. We're talking about water. We're talking about now car insurance. We're talking about transportation, like airfare. Those are important expenses. But what has been troubling me is that when you look at the non-negotiable items, things like transportation, right? How do you get to work? Things like food, energy, shelter. These are basic, non-negotiable. If I am a consumer, I have to pay for those things on a daily basis. And some of the cumulative numbers of what those have gone up since the beginning of inflation starting to rise, they've gone up more than wages have gone up. Because the rebuttal usually to this argument is, well, wage growth has been healthy, so people are making more money, they can spend more money on things like food, energy, shelter, yada, yada, yada. But those non-negotiable categories have outpaced wage growth. So that's where people start to feel the squeeze. But the headline numbers that include everything kind of smooth it out so it looks like we're doing okay. And that's been the issue. So one of the things that happened in last month's inflation report is the Fed had even been saying, well, we're watching the super core number because that's the true underlying inflation data, and that's what we want to get down closer to 2%. Okay, fine. Super core turned out to still be a problem because suddenly motor vehicle insurance was up a ton. And insurance works on about a 2-year lag, a 1.5 to 2 year lag. So remember back when used cars went up through the roof because nobody was flying, they were all buying cars. 1.5 to 2 years later, now we have insurance that's gone up. So before we thought the problem was, I don't know, energy, or we thought it was just used cars in general, or we thought it was something else. Eggs. I remember the whole egg thing. Eggs were too expensive. Now it's like, well, we're going to create an inflation metric that is core services, X shelter, and X car insurance. By the end of this, we'll have nothing left in that metric and it'll mean nothing to anybody because that's not how anybody spends money. So your original question was, how does that break? Part of it is, in a seat like mine, what do I look at to see if it is already breaking? I look at things like credit card debt. I look at things like delinquency rates. I look at things like, why are people taking out personal loans? Are they taking out personal loans in order to pay off credit card debt? And now what's the indebted level of the average consumer and what rate are they paying on that debt? And if that debt is unsecured, what if they can't pay off that debt? Then the bank has to take the hit on that debt. Now, if that happens, this all takes a while, but we have seen delinquency rates tick up. And we know that the average rates that consumers are paying on a lot of these loans are much, much higher than what they've paid for the last 10 years because rates are high. So eventually how it works, or how it would fall apart, I suppose, is that people can't afford the interest payments anymore. They can't afford to pay off the debt that they've been using to sustain these higher prices and sustain the lifestyle that they have. But the fact that everything's gotten more expensive then prevents them from sustaining it any further. So, and who knows, you know what? It could end up that delinquency rates tick up, but they never get to a troublesome level. They never get to that point where it's enough to tip everything over in the other direction. And maybe they come back down. In order for that to happen, I think we need deflation to start working itself through the system. And we're just not there yet.
Yeah, we could become Japan, because that that would be a scary scenario for a
And
lot of
it, you
people.
know, and okay, so just to put some stats around that too, the Nikkei, the Japanese stock index, just got back to its previous high, and that was 34 years ago. It
Hmm.
took 34 years for that stock index to get back to its previous high. So let's hope that we don't end up like Japan.
Hallelujah to that. One more question before we wrap it up here in the interest of time is the housing market, which is another throwing a lot of softballs at you. Let me tell you.
Yeah.
So the housing market, what's interesting is, before COVID was, you could say, had an equilibrium to it. After COVID, you certainly had a lot of people buying outside the city, and you had a little discrepancy in terms of, let's just say, from the equilibrium where it was. But
Mm,
then housing prices kept going up, and yet interest rates went up. So
mhm,
at some point, the housing payments that you'd make on a typical mortgage
mm.
doubled,
Yeah.
and yet housing prices haven't moved. So I'm wondering, a lot of people have different opinions on this, but I'm
Mm.
wondering, like, why is the housing market not going down when it costs double the monthly payments to own a home? Like, what's going on there?
Yeah, well, some of it I think is a very simple rates explanation. So many people had refinanced. The market was completely saturated by refinancing, and consumers were smart enough to have locked themselves into those lower rates. So there are so many mortgages out there right now at 3 or 4%. And I don't blame people for not wanting to get out of them. So there is a big element of the housing market that is totally frozen because people refuse to leave their 3 or 4% mortgage, move into a new house, and take out a new mortgage at 7.5%. So when the 10-year treasury last, I think it was in August, mortgage rates hit 8% because the 10-year treasury was a little over 5. Generally speaking, mortgage rates will track the 10-year treasury, not the Fed funds rate. So you watch the 10-year treasury at about, let's say, 300 basis points, and you roughly get a mortgage rate approximation. So mortgage rates hit 8%. Obviously, it had been a very, very long time since people had seen rates like that. And everybody was like, no, thank you. I want nothing to do with that. I'm not going anywhere. So renting has picked up, which is why you're seeing that funky way that we measure rent, or we measure shelter in inflation by using owner's equivalent rent. So rent costs have gone up because people don't want to sell their house and buy a new one and start a new mortgage. The only transactions that are taking place freely are all cash transactions. So because you don't have to finance it, so it doesn't really matter. Well, who's transacting in all cash? The really wealthy people that have that cash laying around that can go buy a $3 million apartment in New York City in all cash. They're not concerned with the rental market. They're not concerned with the rates, the mortgage rates. So some of that is keeping prices elevated. And you also have to look at the fact that if somebody were forced right now, they're forced against their will, really, to go buy a house at high rates and buy a house at high prices. So until we have comps that come in and the market unfreezes and people start to do that again, you're going to see prices probably stay elevated. Now, there's again a business cycle element of this. If there is a downturn, you'll see the housing market fall apart pretty quickly. But because we haven't seen that yet, here we sit. So the other weird little element that I think is here, and this is more of a timing element than anything. If rates come down quickly, if the Fed starts cutting and rates come down quickly, and there is no economic contraction that accompanies that, then you'll see people start to come out of the woodwork, come off the sidelines suddenly, who've been waiting for mortgage rates to come down. And it's a relative game. It's like, well, 6% looks a lot better than 8%. So maybe now I'll do it. So then you see people come back into the market, which again would keep home prices elevated. So it could be a situation where the housing market doesn't really come down much at all during this cycle. And the last piece I would say is there are a ton of millennials out there, there's a demographic shift, a ton of millennials and even some Gen Zers that are at the age where they're engaging in household formation. They want to buy a house because that's the stage that they're at in their lives. And they're first time home buyers. So they don't have this reference point of, oh, my first mortgage was 4%. This seems outrageous. It's just what it is today. So they're doing it. And that again has kept demand healthy.
That's assuming they can actually buy a house,
Right.
because the numbers are such that we're not seeing those first time home buyers in the same degree we were, because they can't afford anything.
Mm-hmm.
It's
Mm-hmm.
yeah, it's a very challenging situation. Well, hopefully it gets resolved, because and anyone who doesn't already own a home or needs to move, I mean, some people need to move and then they're really
Right.
in trouble.
Right.
But
Yep.
yeah, they need to bring back the assignable mortgages of the
Mm.
80s. That was a
Oh
great
boy.
time. But of
They
course,
don't
that's
need to
when
bring
rates were
back the
high.
15% mortgage rates, though.
No, no, not unless you're on the other side of it. That's okay.
That's true.
Yeah, 15%, 30-year treasuries is pretty nice.
Mm-hmm.
Well, cool. Well, Liz, I really appreciate you coming to the show and sharing your wisdom with us. Any final thoughts, and where can people find more about you?
Sure. So I mentioned at the top of the show, I generate a ton of content. You can find a weekly blog that I post. It drops every Thursday morning. You can find that on SoFi's website under investment strategy. I also have a monthly podcast called The Important Part that usually posts about the third week of each month. So look for that wherever you get your podcasts. And follow me on Twitter. I am at Liz Young Strat, or I'm sorry, it's called X now. Follow me on X at Liz Young Strat. We post daily market information, daily data drops, and some takes on what we think it means in the moment.
Great. Well, Liz, really appreciate you coming on the show, sharing your wisdom with us. We'll probably have you back in the future. This has been a treat for me, so thank you.
Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Liz. Really appreciate her coming on the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Good morning, everyone. Excited to talk money and investing.
Yeah, so this will definitely be a fun one. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Good to be here. Looking forward to some good conversation.
Nice. Yeah, me too. So, Barb, what were some of your takeaways from the interview?
Liz was the most amazing communicator. She talked about issues that were really important: inflation, business cycle, so many different market related topics, but they were in such a clear and accessible way. And she didn't really dwell on predictions. This is exactly what's going to happen, but more on things to think about. So I was totally enamored with her style, her information, and I'm excited to discuss it.
Awesome. And Phil, what about you? What are some of your takeaways?
I had similar takeaways. I mean, normally, I don't like to listen to this kind of stuff because it's just a bunch of speculation about things that might happen, but we don't really know. I always like to tell people that my crystal ball is both cracked and cloudy, so don't count on me to make forecasts. But she did it. She communicated well, as Barb said. I liked the way that she applied her thought process and her reasoning. She never said that this is how it's going to be. It was a really interesting, enjoyable listen.
Good, good. So let's talk about that. Phil, you mentioned information is cracked and cloudy, but I think a lot of people don't reflect on the fact that they just hear information and they don't dig any further. They just say, "Oh, it must be true." And there's tons of information in air quotes out there, and everyone's got some. And the question is it true or is it not true? And it puts people into kind of a confused state because they say, "Well, I don't know if it's true." So Barb, where do you get your information?
I get my information the old school way from publications such as the Wall Street Journal, the New York Times, Market Watch, Barron's, the reports that come out of major brokerage accounts, major brokerage houses like Fidelity, Schwab, Vanguard have excellent research. And I know who does well-vetted articles. I happen to write for Investopedia, and I know how well they vet their articles. I go to them an awful lot. Forbes Advisor, I write for them too, so I know they are well vetted. So I get my information from them. I want to share a little story about someone who sent me a clip about a modern current event. And I'm not going to talk about it because it's super political, but he said, "Oh, look, isn't this great news about this modern situation? This just happened. It's so positive." And I said, "I didn't hear anything about this. Where did you get this?" So he says to me, "Oh, it's from this YouTube channel." So I went on the channel and I'm like, this doesn't look legit to me. And it wasn't. The news was false. And so I just want to say, getting all your news from X or Facebook or Instagram or YouTube, if you're going to do that, really know that the source is credible.
Yeah, it brings up a great point, Barb, because at first I thought you said the old school way. I thought you were going to say carrier pigeon. I'm glad it was more recent than that. Um, but realistically, the news, it's really hard to get information. Even some of the legit news sources sometimes are susceptible to being wrong. Sometimes it's deliberate, sometimes it's just sloppiness because the news has degraded over time. It's not the news.
And there are biases
Yeah.
on every single site. And they're influenced also by advertising who pays them. Although they say they're not, you can't help but be. So yeah, you got to be cautious with every site.
Yeah, there was actually a really good video clip where it showed CNBC, and it was like, I think they were pitching somebody. It was like Charles Schwab I'm just making this up. It was like, they're talking about, "Oh, Charles Schwab is a great stock, this and that," and then and then 5 seconds later, it clips to a Charles Schwab commercial. And it showed like a ton of these going through CNBC, and it's like, we're not biased. And it was the funniest thing. I wish I could find this. It was one of the funnier things I've seen. But Phil, what about you? Where do you get your information? You're a deep digging data kind of guy. Like, where do you get your information? Like, how do you discern what's correct and not correct?
A lot of the sources that I use are going to be the ones that Barb mentioned. If I'm looking for information on a company, I'm going to go to their 10K or their 10Q. I don't want to go and see what somebody else said. I want to really understand it. You know, we talk about how there's all these other information sources. One of my favorite things that happens, my story is somebody will say, so-and-so says the market's going to crash. And I say, okay. And I look at the name and I go do an internet search and I see how many times they've said that. And I'm like, that's what they're that so much of it is out there to scare you, right? So a broken clock is going to be right twice a day. So at some point, one of those people that has these stories about this thing's going to happen or this ridiculous event's going to happen, whatever, they could be right, but that doesn't mean that I want to put faith in them. I want to be able to find multiple sources. And I talk a lot about confirmation bias too. If I see something and it agrees with me, I want to try to find somebody that has the opposite viewpoint so that I can really understand it. I mean, I think that's a big part of looking at information too, is making sure you look at both sides. But to me, I want to get as close to the source as I can. I want to go with reliable sources. I look at the Wall Street Journal, Barron's, New York Times. Those are some of the ones that I use. I might look at data that JP Morgan puts out a really good thing with a lot of good data that comes out for advisors that I like to look at. But I want to make sure that it's a trusted source. I always look at where it came from. Like, if I think back to my tax roots, and when I had to look up tax things, like somebody could say something on tax, but I want to know who said it, because are they credible or not? It's really important to understand where it came from.
I was just reviewing a trust of my family, and I wanted to go over the parameters and try and understand the legalese, which between you and me, I'm not a lawyer and it is hard, but it referenced IRS law. So I'm like, I do an internet search and there's all these people writing articles. And so I said, I'm going to the IRS. So I make sure I wade through it. And granted, I had to read it 3 or 4 times, but to your point, Phil, I want to make sure the interpretation I have is the correct one. Kirk, I think we also want to talk about, we have all this information, then what do we do with it?
Yeah, that's a great topic, Barb. So let's get into that. What are your thoughts on that? I mean, once you get the information, what do you do with it? Do you act on it? Do you not act on it? I mean, we're bombarded by information and data every single day, so much so that it usually overwhelms us, so we don't make any decision. So how should people be thinking about this?
Even for professional investment people like myself, I've been in the markets for 40 years. And I know the market history like the back of my hand. I study that. I'm fascinated by that. I still get caught up in FOMO, anxiety, fear, greed, the typical, behavioral finance reactions. But I know enough to say, don't act immediately. Don't make a decision immediately. I'm not saying set your asset allocation and go day in, day out forever. I mean, that actually would work fine, if you're young, and if the past replicated the future, but you don't know that. So before acting on any information, take a deep breath and review your own investment policy statement. And we all should have one if we are an investor. Now, sometime interest rates are going to go down. We don't know when, and we don't know how much, but there's one thing that is a certainty, and that is bond funds, when interest rates go down, they will appreciate. So that gives you enough information to know that maybe at some point you want to move some of your cash, which is in high yield money market accounts, into some intermediate bond funds, but you don't know when. And, but that's information that might be useful to act on. You're not going to hit the exact right point to do that, but over the long term, that may behoove you financially. that's an example, one of the things that I think about with the information that's out there.
Yeah, that's helpful, Barb. What about you, Phil? Like, how do you take the data and filter it and use it to make decisions?
I think the most important thing to me is to maintain a long-term focus, because that keeps me from acting irrationally. Most of the time, look, it's easy to fall victim to any of the behavioral biases, right? There's a cycle of market emotions that talks about how it shows how we can buy high, we sell low. There's the story I love that Carl Richards tells, that it's like you go into a car dealership and you say you want to buy a car, and they say, great, there's a special today, we doubled the price. And your response is, I'll take two, right? That's sometimes what we do in the market. We buy when the price is really high instead. So one of the things that I tell people is, if we're investors, we're making an implicit assumption that over the long term, the market's going up. I know I can't time the market, so I'd rather have a diversified approach, rebalance, and I have rules for rebalancing, so I don't just do it. I have a process. You think about process. If you have a process that you regularly stick to, it makes it so much easier to figure out where your strengths and weaknesses are, because you can have a lousy process and you can still be successful. It's dumb luck, but it happens. But you don't know that if your process is all over the place. But if you have a good process, if you get a good outcome, that deserves success. But if you get a bad outcome, that happens. But when it does happen, then you want to go back and look at your process and see if it had holes in it, if there's something that needs to change. But for the most part, I really try not to pay too much attention and act too much on what's going on day to day, because in the long run, it's going to wash out. So I think maintaining a long-term approach, to me, that's the key.
Yeah, no, I think that's a great way to think about it. I was reading a book the other day about marketing, and I saw some interesting correlations, you know, because with marketing, a lot of people, they'll just do something and it'll be like, oh, it didn't work, and they'll just stop, right? And be like, that was terrible. Like, this stuff doesn't work, right? Right. Like, okay, well, maybe you should try something different, or try a different version. But anyway, people just like give up if it doesn't work the first time, right? Or they do something that does work, they're like, I'm a genius, right? Or they try something, or like, I knew why that worked. And the reality is, like, when you, like, nobody really knows. Like, if you have a thesis, you're like, I'm going to try this thing. I'm going to put flyers on people's windshields, for example. Be like, okay, let's see if that works or not, right? You have a thesis that you think it'll work, but you don't really know until you do it, right? And you try it, and then and whether it works or not. But the funny thing is, with marketing, you don't know why it works. Like, you might put something out, you might do a Facebook ad and it says, like, come now, 50% off. And you're like, oh, they came because of 50% off, where actually they came for some other reason you might not discern. So you don't always know why it worked. And I thought it was really interesting because it's so similar to the markets. It's like, you have a thesis, you're like, oh, I'm going to invest in, ABC stock because I think the trend is going up. Okay, and you invest and it goes up. I'm a genius. I was right. It could have had nothing to do with your thesis. It could have been something completely different, right? Like we talked about earlier, like, why is housing going up? I don't know. Like, no idea why housing's going up. I think it should be going down. But my thesis is wrong because it's going up, right? Some other reason is causing it to go up continuously. And so, I think the realization that we all should have is not trying to find the answer, right? You don't need to know why, because you're never going to know why. The market is way too complicated for you to know why. We all want a reason. Like, human nature drives us to have to know a reason why. Why is this happening? And we have to somehow get beyond that, because when you need to know why, you're going to drive yourself crazy, because you're never going to know. It's like, wow, gold dropped. Like, I remember back 2011, I think it was, like, gold dropped like overnight. It was just like instantaneously just dropped. And like, oh, it's because people were selling because of, it was like April 15th. People had to pay their taxes. I'm pretty sure they didn't sell for that reason, right? Or it's because of this happened, or the Chinese fat finger trade. Or they came up with 50 million reasons. Probably none of them are correct, right? No one really knew why. And you're not going to know why. And you have to be comfortable with the fact that you're never going to know why. So, you have to come up with methodologies that work, right? Find something that works, find a system that works, follow that system. It's not always going to work, right? Sometimes it works, sometimes it doesn't, but find a process that works for you, right? Just like Phil said. So,
could I add one thing to that too?
Go ahead.
The other thing too, you mentioned a thesis. When you have a thesis, write it down, because after the fact, if it worked, you might think, oh, I thought this, or if it didn't work, you might think I thought that, but write it down so that way, when you get to the end, at least you can see what you were thinking. We still might not know, but just the practice of saying, here's why I did this. It helps a lot, because your thinking at the time goes away when you get into the future. Whatever you're thinking at the time you made that decision, you're probably not going to remember. So try writing it down when you do it, because it can help a lot.
Yeah, I think that is a great strategy, Phil. I know traders use the trading journal, so they always write down like what their thesis is, why they're buying, and the parameters of what they're doing. And then when the why changes, they assess it and be like, well, because I think earnings are going to come out and it's going to be positive. And okay, well, earnings came out as negative. Well, okay, I probably shouldn't own it anymore, as an example. Like, doesn't matter the reason. Like, if you have a reason to buy it, if that reason changes, you should assess whether you still want to own it, right? So having that written down, like Phil said, is very important. Like, all the successful traders and investors do it. We do it. It always helps to. The problem is we always justify in our minds of, well, I still want to stick with it, right? It's like it's like putting in a stop loss. Like, you buy it at 100, stop loss 95. It gets to 95, you're like, you know what? I think this is going to bottom out and it's going to go right back. Then it goes to 94 and 93, and be like, it's right there. Like, it's going to come back. And you come up with this crazy justification in your mind of why you still want to hold it. And basically what that is that's your ego talking. That's your ego saying, you're not wrong. You're really smart. You got to keep doing this. You're going to get it right. And you're going to be justified in the end. And then it's 30 and it goes down to 80 and 70. And we're like, it's definitely coming back now. Your brain does that to you, right? So if you write it down, you have it in writing, you're like, this is my rule. I'm breaking my rule right now because I'm coming up with something else. And it just helps support your initial thought, which is probably the most accurate one. So, Barb, let's get into the housing markets. I'm confused, right? We talk about this all the time, especially on Fridays with Doug. The housing market's crazy. Prices are going up. Nobody can afford it. Nobody's moving, but yet the house prices keep going up, and people are still paying ridiculous prices. What's going on?
Living in the heart of Silicon Valley, where between you and me, it is expensive. Housing is insanely expensive. And in my neighborhood, which is a very moderate middle-class neighborhood with, because we're in Silicon Valley, still has, if you look at the national landscape, very expensive houses. People are buying. And I don't have a clue. Prices are not dropping. I was prepared for prices to fall. House across the way just sold at top dollar, same price. Didn't appreciate since, 2022 when interest rates were lower. But it didn't go down, which would be a logical explanation given that interest rates have more than doubled. So I have no idea. I think part of it might be the supply. There's the historically low supply of housing, predominantly because, as was discussed on the podcast, people like myself who are in a house, I'm not selling. Mortgage rates are rock bottom, and why would I sell to pay 3 times the mortgage? So a lot of us older people, or people that got into the market or have refinanced with low mortgage rates, we're not leaving unless we absolutely have to. They're not building enough new housing. So I think you can look at, why is the market pricing stable? I believe there's an economic reason, which is supply and demand. There is just more demand than there is supply. And so people, for whatever way, are finding a way to buy in. Maybe they're spending more of their disposable income on housing than is recommended or than is typically spent in the past.
Well, I think that's the real question is how are people affording this? I mean, I think that's the real question we have to ask, right? Is how are people affording it?
I don't
Because
know.
at some point there's a limit, right? And maybe people were like you said, maybe people were underspending and now they're overspending, but it's still within the limits. Now the banks won't allow you to borrow if you're over a certain limit. So there is a limit to that. But still question, like, how are people affording it? Like,
I honestly don't know. I mean, I can say out here, there is a huge divergence in salaries. So if you work in the tech industry, you are making ungodly amounts of money. These software engineers and tech people are making $200,000, $300,000, $400,000 a year, and then they'll have bonuses, et cetera, et cetera. So you can afford a house with that salary. But then there are the people that are not and are making, $7,500, $125,000 a year. And I don't know that at least in the Bay Area, that they are buying.
yeah, I mean, it kind of brings up this topic. I mean, you got new homeowners, you got people who are, kids. I mean, we all have kids. At some point, they're going to want to buy a house, and not going to be able to afford it if things don't change. So it's a really interesting challenge. We talk about it in the show back and forth. There's a lot of dynamics, and I think the important thing to think about is if our thesis isn't playing out, it means our thesis is wrong. So my thesis is interest rates going up means that house prices should go down. Like that's the natural order of things, right? And that's the way it should work. As Barb said, there's supply and demand problems, right? And people aren't leaving. There's also a volume problem, right? It's like if you live in $1 million house, like around here, everything's $1 million house. Like it's crazy, and interest rates are up, and there's still $1 million houses. If you're buying $1 million house and you're paying 3%, whatever that comes out to, like $4,000 a month, $3,000 a month, whatever it is, 3%. Let's call it $5,000 a month is what you're paying. But now interest rates are 7%, 8%. Well, now it's like $14,000 a month. So if you're going to sell your house at $1 million and buy a $500,000 house, you've got the same payment. So you own half the house for the same price. Like, why would you ever do that? It doesn't make any sense. And of course, younger people can't afford it. So I mean, the way I think of it is the real estate market's frozen. Like it's frozen over and stuff isn't moving. Stuff is moving, but not to the extent that it was. So I find that really interesting. And I don't know how long people can hold up doing this because wages aren't going up to the same degree that housing is. So I don't know. You have any thoughts on this, Phil?
I mean, I definitely think that supply, that's the only one that makes sense. I would say before we started that I have a client that they got divorced, they put their house on the market, thinking it's not the right time for a house of that value. And they get offers that are at list or above. And I'm like looking at the mortgage payment. And like you said, Kirk, it's $15,000 a month. That to me, that's crazy. And you mentioned, Barbara, like your rate's low. You're not going anywhere. Think about if you're retired and you don't own your house. I mean, fully. So you want to downsize. But when you downsize, if you still have to have a mortgage because you don't have enough equity, your payment could be more than where you are now if you were fortunate enough to refinance during the time that rates were so low. I look at the rate that I'm paying on my house. There's no way that my mortgage payment, there's no way that I could duplicate my mortgage payment if I moved. There's no way. It would automatically go up because the rate is so low. That's a big part of it so that's forcing people to not move, which is affecting the supply problem even more. And then there's an interesting twist that I heard somebody say too, is think about it. A lot of times you want to help your kids. So you mentioned if you got kids, it's hard for them to afford. So if you're in position to help your kids, you think, oh, that's great. But here's the problem that comes with that. you give your kids the money to move into this neighborhood that they couldn't afford. And we all want to keep up with the Joneses. So the other people that are living there, they have all these things. So now you put your kids in this neighborhood where they really shouldn't be, but you gave them the money to be there. And now what are they going to do? Because now they can't do all the things that their neighbors can, because those neighbors that have lived there for a long time and have a lower mortgage rate and a lower payment, even if you gave them enough to keep their payment down, they still don't have the money to do everything else. So you really have to be careful about that too. And that just further mucks up the whole system. But why housing prices are where they are? Supply is the only thing to me that makes sense. But it feels like there's something else, but I don't think anybody knows what it is, because we're all kind of baffled by the fact that housing prices have stayed at the levels that they have, while mortgage rates have gone up from, below 3 to where they are now.
Yeah, I mean, this gets back to the point I was making earlier. We never know. Like, you never know why things are happening. I majored in economics in college, and one of the most obvious things is you don't know until after the fact. Like, people predict things and they're always wrong, but after the fact they justify it with a theory. Like, oh, this is why it happened. Like, where were you before? Where were you before when I needed to know the answer? Like, of course, it's like, oh, well, you put all these pieces together and here's what the puzzle looks like. Yeah, but where was the picture when I was trying to put the puzzle together, right? So I think it's interesting. Like, we don't really know, and even after the fact, we don't always know. Like, we'll put together a correlation matrix of like, oh, here are the correlations and here's why it happened, but you don't really know. And I think we have to all get beyond the fact that we need to know things. Like, you don't always need to know. What you need to know is, are there things that will probabilistically lead to a better outcome? Like, buy and hold over 100 years is probably a good strategy. Over 1 or 2 years, doesn't really matter, right? And so you need to come up with theories that work, that are successful theories, right? That it doesn't matter why, as long as your success probability lines up with that thing. It doesn't matter why, right? It doesn't matter who the best performers are, why Warren Buffett did great. He talks about it, but he hasn't done great lately, right? Like, his theories of why things work and why he's done so well, they haven't worked for him lately. So is he wrong? I don't know. But you don't know, right? So I think we just kind of look at correlations and we assume they're causative, but they're not always causative. And so just understanding that's really important. But we can feel comfortable probabilistically and say, well, Warren Buffett, yes, he's been wrong lately, but he's been right over time. And we can look at it and say, all right, based on that, what do we think is probabilistically going to be a best play moving forward, right? That's the best we can do, right? And that's how we kind of make decisions to some extent. But let's look at market cycles, Barb, because we talked a little about market cycles. What do you think? Are we in late cycle, mid cycle? How do you know the difference?
I loved when the guest said, well, we're either in late cycle euphoria, which means at some point the market is going to crash, and it's going to crash hard, or we're in the middle of mid-cycle expansion, which means we've got room to grow. Markets are going to expand for a while. And I just thought that was so beautiful. You know what my answer is? I have no freaking idea. And that is why I recommend everyone who's got any kind of investment portfolio, pull out your calculator, take a few minutes and scenario or stress test your portfolio. And that way, if we hit that market crash where your equity portfolio goes down 30 or 40%, you will be prepared and you won't feel like you have to sell. And so you know what the worst case scenario is, and you've decided in advance to do that. And it is super easy to do. You just take the portion of your stock portfolio, let's say it's 50% of your total portfolio, and you multiply it by, 0.60, then that demonstrates a 40% loss. So you see how much remains? And it's like, okay, can I tolerate this if my investment portfolio drops to this level? Am I going to be able to live with that? And if not, then you want to switch some of your risky stock assets into safer cash equivalents and although bonds haven't been that great recently, historically bonds are less volatile. And historically, they will support your stock market losses with a little bit of ballast.
Yeah, that's great, Barb. What about you, Phil?
So I want to add one other thing to an extension of that. It's not just stress testing your portfolio, but also I have this year my firm I merged with somebody else, and so she switched, and now we're using the software that I used to do financial plans. She switched from a different vendor, and she asked me, "So what returns are baked into your software for the future market?" And she said, "Here's what she had," and I said, "And here's what I have." And I talked to the vendor, and it's like, "Well, we use historical 50-year returns, but we never adjust them." And I'm like, "Really?" And then I said, "And now let's look at," I mentioned JP Morgan as a source that I like to look at. And, JP Morgan puts out their projections, and I know they're just projections, but they're different than that too. The ones that are in the software are based upon 50-year historical returns. But think about what the difference is if you're trying to project out where it's going to go. If you use historical market returns versus you say the market's valued in that euphoric state, right? So that means there's going to be some down. Like, think about that too, because that really makes a huge difference. Like, I know when I'm running a financial plan, there's a stress test feature. And I can say, what if the market falls by 20%? What if the market falls by 40%? What's the impact? You have to understand that, but also just think about the returns too, because a lot of times the return projections are they're crazy. So you have to think about a lot of different things. It's not as simple as just there's market cycles, right? There's returns, there's stress testing, all these things factor in. They're all relevant. I'm not saying that I know what the answer is going to be, because like I said, my crystal ball, it's cracked and it's cloudy, so I'm making no forecasts, but I'm just saying there's a lot of different variables that you have to take into account, and you have to find your comfort. And it's easy to say my risk tolerance is high right now because the market's going up. When the market goes down, oh, why am I so heavily invested in stocks?
Well, and there is one rule that has come to pass over many, many years, which is reversion to the mean. And there's really an expectation, at least in my mind, that that's going to happen. So it refers to the valuation using something like a price earnings ratio or one of the common valuation metrics. So right now, the price earnings ratio is higher than average, which suggests and has proven true over time that at some point, valuation metrics will return to that average. And so in order for that to happen, either earnings have to grow insanely incrementally or prices have to fall. And so we don't know when that's going to happen. The market can go up for, a long, long, long time, as we all know. But at some point, it's very likely that it's going to go lower. And so that gets back to Phil's expectation or his software at a time when we have really high valuations, which we do now. They're not as high as they were in 1999, but the average S&P 500 metric is, in the 30% range right now. And it was, if you look at historical means, is probably in the mid-teens. So we're historically overvalued. So what that means is if you're going to project the historical long-term returns of the stock market, which is 9 or 10%, what you're saying is you think the stock market is going to continue to be very, very overvalued indefinitely.
Yeah, we went through a period of this in the late 90s too, when people said, well, this time's different, right? And every time I hear this time is different, it always scares the crap out of me, because that means like, it's bubblish. It's oh, the dynamics are different this time. And in some ways, it's always true and it's never true, right? It's always true because every time is different. And at the same time, history reflects the past. So are we going to stay at 30 PEs forever? No, absolutely not. Are we going to go down to 5? Maybe. I mean, maybe not. But the reversion to the mean, I always think about it as reversion past the mean, right? If we're past the mean, that means it's going extreme in the other direction first. And that's the reason. I mean, it doesn't always happen in every market, but it definitely happens in the US, where, we have these booms and then huge crashes and then booms again and crashes. We don't have this like easy sloping market for whatever the Fed is doing, which, most people don't agree with. It's not creating a comfortable environment. It does on a day-to-day basis, but if you look at it 10-year cycles, it's really crazy. Like the 2000s, where it went down, depending on which index, we're up to 70%, I think, on the NASDAQ, and then goes up a lot, and then it crashes again, and then goes up. It's crazy, but that is the market we live in. So if you're at the top, as Phil said earlier, like, this is the only place where you go in and want to buy something, and they're like, all right, let me just double the price for you. Like, oh, okay, sure, I'll buy that. Anyway, we got to wrap it up here. So final thoughts from you, Barb.
I just think that you want to write down your investment strategy, and then you want to look at it and you want to follow it as best that you can. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and on my Barbara Friedberg YouTube channel.
Great. Thanks for coming on, Barb. And Phil, final thoughts from you.
So I agree. You want to write things down. It's writing down your thesis, writing down your process. It's sticking to them and taking a long-term approach that keeps you from trying to be so reactive to everything that you read. It's making sure that you look at different sources that are trusted, but also that don't all share the same viewpoint, so that you understand both sides. As for me, I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our blog. Thanks for having me today, Kirk.
Great. Thanks for coming on, Phil.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.